Let's start looking at the solution to this example. And I want to start by looking at the general journal. The first journal entry takes place on 15 April 2019, which was the date that Friedrich Limited acquired the investment in the shares of Kolwa Limited. Now, this is initial recognition date, and you need to know your financial instrument rules to know at what amount do we recognize this investment initially. Now, if you have a look at your rules, it says that financial instruments are always recognized at fair value. Day one needs to be at fair value. The question is, what happens to the transaction costs that you paid on day one, on initial recognition? Do they form part of your financial asset, or will they be an expense that you take straight through to profit or loss? And to decide whether it's either capitalized or expensed, you need to know your rules of financial instruments. If you are in the category at fair value through OCI, your initial recognition will be at fair value like any other initial recognition of financial instruments. And if there were transaction costs, those transaction costs will also be capitalized initially to the investment. So your first journal entry, debit investment credit bank, is the recognition of the investment in shares at the fair value of those shares on the date. The second journal, debit investment credit bank, is the capitalization of your transaction costs of 15,000 Rand. They are not an expense. If you are in the category at fair value through OCI, you are not allowed to initially, on day one, expense your transaction costs. They have to form part of the initial cost of this investment. Nothing else happens in the 2019 year, and we get to the reporting date 30 June. Now, because we are in the category at fair value through OCI, at the reporting date, this investment needs to be at fair value, and any adjustment, any fair value movement up or down will go through OCI and end up in the statement of changes in equity in a new column called the mark-to-market reserve on equity instruments. So if we have a look at the journal on 30 June 2019, the fair value at that date is given to you as R3.75. So your investment needs to be adjusted to R3.75 per share. So you do a calculation. You have 100,000 shares, they need to be at R3.75, which means they need to be at 375,000. What is the investment at the moment? Don't forget your transaction costs. Your investment was recognized at 350,000 fair value, and then you added on to that the transaction costs. So the movement is to go from where you are at the moment. If you look at your investment T account, what is the balance at the moment? From there, move either upwards or downwards to the fair value at reporting date, which is 375,000. Now, during the 2020 financial year, again, nothing happens and we reach reporting date. Because we are in the category at fair value through OCI, at reporting date, these shares, the investment needs to be presented at its fair value. So we would need to do a fair value adjustment. In this case, the market value on this reporting date is R4 per share. So our 100,000 shares at R4 each need to be measured at 400,000 on reporting date, What is it measured at the moment? What is your balance at the moment in your T account? The 375,000. And you move from the current balance either upwards or downwards, in this case upwards, to reach the new fair value. So your journal entry, debit investment, because it's an upwards movement, credit mark-to-market reserve on equity instruments in OCI. In 2021, up to the year end, up to the reporting date of 30 June, nothing happened. So we get to 30 June, because we are in the category at fair value through OCI, the investment needs to be measured and presented at its fair value. The fair value at the moment is R3.80. We have 100,000 shares. So our investment needs to be on the statement of financial position at 380,000. What is the balance at the moment? What are you measuring the investment at the moment? It's the previous fair value adjusted balance of 400,000. So in this case, there is a downwards movement. Remember, it's not an impairment. It is short term. It will recover. The share price just dropped a little bit. We are not recognizing an impairment. We are recognizing a downwards fair value adjustment. Downwards means we would have to credit the investment. It's going down in value. Where do we take the debit? Still through OCI. A positive or negative movement goes through OCI. It's not like a revaluation surplus where you have to decide, where do I take the downwards movement? Does it go to the revaluation surplus? Does it go through profit or loss? It's not the case in the category at fair value through OCI. Any movement, upwards or downwards, always goes through OCI. That means your mark-to-market reserve on equity instruments in your statement of changes in equity can actually be a negative amount. You can have a negative equity item if every single movement on this investment had been downwards.